I think these are very interesting now. I think the high margins, cash rich nature of the business, the terrific sort of investment credentials of this business where you don't need that much in the way of capital to grow earnings. I think that deserves a pretty premium rating, to be honest. Hello, and welcome to the Private Investors Podcast, the podcast where keen stock pickers Roland Head and Maynard Paton talk about managing their share portfolios. Roland writes about his dividend stocks at rolandhead.com, while I write about my small caps at maynardpaton.com. This time we cover IntegraFin and the investment potential of investment platforms. But before we get started, I would like to talk a little about the future of this podcast, and indeed the future of our sister podcasts, the Value Trap podcast with Mark and Bruce, and the Investors Roundtable with all four of us. The feedback and comments we have received about these podcasts have been very encouraging, and Roland, Mark, Bruce and myself are really keen to continue recording our investing conversations. And we all hope you have enjoyed our discussions and want to keep listening as well. But as you might imagine, these podcasts do involve a fair amount of time and effort, and they do require some skilled podcast editing. So we've had to make a decision. Do we continue with our podcasts or not? Well, I'm happy to say we are continuing. And here's the important news. From the 1st of August 2023, we will introduce a modest monthly charge to listen to the Private Investors Podcast, the Investors Roundtable Podcast, and the Value Trap Podcast. The charge is £12.50 a month, and your support covers our costs and helps us produce high-quality investing conversations. Now, we did consider taking adverts and sponsors, but neither Roland, Mark, Bruce, or myself like podcasts full of adverts. And none of us really wanted to pander to sponsors either. Bottom line is, we just want to be able to speak freely on our podcasts and only focus on you, the listener, rather than think about pleasing advertisers and sponsors as well. Now, I know full well private investors never like to pay for anything, which is fair enough. There are plenty of free podcasts out there for you to listen to, and there's no hard feelings if you do not wish to pay. But if you do want to listen to four experienced private investors talking about shares, then please do consider a subscription. And if you do join us, you can easily submit investing questions for the four of us to answer in a future podcast. Our podcast will remain free until the 1st of August, but if you subscribe before then, you can enjoy our podcast for just £10 a month. Our podcasts after the 1st of August will still be available on all major platforms, such as Apple, Google, and Spotify, and connecting to our subscriber-only feed can be done at a click of a button. Just visit pipod.co.uk, which is pipod.co.uk to find out more, and there's a link in the show notes as well. We all hope you can join us, and if you do, you'll get to listen to real investors with real money talking about their own shares and portfolios, all trying to find their next great investment. And if you do join us before the 1st of August, you pay £10 a month instead of the normal £12.50. That website link again, pipod.co.uk, and I hope you'll join us there. Now, let's get started with IntegraFin.
I didn't really know much about IntegraFin until we started planning this podcast, so I'm guessing quite a few of our listeners won't be familiar with this business either.
Essentially, IntegraFin is a Hargreaves Lansdown or AJ Bell equivalent for financial advisors. So if you're a fan of Hargreaves Lansdown as an investment or AJ Bell as an investment, then IntegraFin could be a share for you. So it operates a investment platform called Transact, and financial advisors put their client money onto the platform and they can buy and sell investments on behalf of their clients. It just seems to be a reliable business. It's got lots of recurring revenue from annual management fees and product fees. In fact, 98% of revenue last year was from these recurring management product fees. And there's client retention as well. So every year, 97% of clients stay on board. So revenue income seems pretty sticky as such. And one really impressive feature, I think, is the consistent net inflow of client money onto the platform. So the difference between money coming in from clients and the money being withdrawn is the net inflow. And they've had positive net inflows every quarter for the last 6 years at least. So every quarter, somewhere between £700 million and £1,500 million of client money comes onto the platform. So that's a super performance, especially during a difficult 2022, which gave every reason for clients to move money off the platform. So that consistent new money from clients, that I think validates the strength of this business to outside shareholders.
Yeah, the economics of the business certainly seem pretty good to me. I think revenue has risen by nearly 50% since the company floated in 2018. And I estimate the underlying pre-tax profit was about 60% higher last year than it was in 2018. Consistent inflows of client money have really seen assets rise. I think client assets have risen from 33 billion in 2018 to 54 billion today. So I can see why you got interested in this stock. And I suspect that one other thing that may have caught your eye, the company's founder, Michael Howard, is still on the board of directors.
He is, yeah. So I do like owner management. I do think it does make a difference to outside shareholders when you've got a founder or somebody on the board with a large amount of stock. They seem to think more about shareholders than your typical standard chief executive does. So Mike Howard is still on the board with a large shareholding. Plus, you've got a business with strong margins, generous cash flow, cash rich, which is a good combination, I think. And the valuation now is intriguing. This share was the other year trading at 40 times earnings, and last year it fell to 15 times, I think. The yield now is, I think, above 4%, and the valuation is becoming, once again, quite intriguing, I think. But there's greater costs creeping into this business, or let's say marching into this business a little bit, plus standstill revenue, which is causing lower profit, which we'll discuss later in the podcast. So perhaps not the absolute bargain basement share price at the moment, but it's becoming intriguing and definitely on my radar at the moment.
So do you own shares in IntegraFin at the moment?
No, it cropped up on my SharePad radar last year. So I wrote about it for SharePad last year. I thought about buying, especially when we discussed Bioventix in episode 8 of the Private Investors podcast. We discussed that company's reliable revenue with the repeat royalty income it generated from its antibodies. So that got me thinking about IntegraFin and other companies with repeat recurring revenue. And so IntegraFin now, having thought about it with its repeat recurring annual management fees, that's towards the top of my watch list now. I need to double check with you first because to make sure I'm on the right track.
Doesn't seem like a bad time to get interested. I think the shares, they floated at about £2 in 2018 and they tripled to £6 in late 2021, but they've since fallen nearly all the way back again. I think they're about 240 as we're talking. So that's not really much higher than the IPO, considering the growth in profits and client assets since then. So at first glance, the valuation looks potentially interesting to me. And as you mentioned, the yield is up to 4% now. It's probably also worth pointing out, though, for some context, that shares in Hargreaves Lansdown and AJ Bell have also really fallen sharply over the last year. So this whole sector has really sold off. So IntegraFin isn't necessarily the only choice where the valuation is starting to look appealing. We keep mentioning Hargreaves Lansdown and AJ Bell as competitors, and although it's true they do compete with IntegraFin in some areas, there are some clear differences too.
Yeah, so IntegraFin, just to be clear, serves IFAs, financial advisors only. So if you want to get your money onto the IntegraFin platform, you've got to go through a financial advisor. Hargreaves Lansdown serves retail customers only, so that's the likes of you and me. And AJ Bell serves both retail customers and financial advisors. The products on those three platforms differ as well. So all three offer standard products such as ISAs, SIPs, dealing accounts, and so on. But IntegraFin also offers various products for financial advisors, particularly to mitigate inheritance tax and capital gains tax as well. Some products called onshore, offshore investment bonds, which we'll touch upon a bit later. Some of the accounting differs as well. So these more sophisticated financial advisor products, the accounting means that the cash held by the client is actually on the company's own balance sheet, which distorts a lot of the accounting ratios, which is a little bit confusing as well. But just to put it into context, client money on IntegraFin's Transact platform, as you've said, £54 billion. AJ Bell, £75 billion of client money. And Hargreaves Lansdown, at the last count, it was a mighty £132 billion.
Yeah, so there are some differences, but I think there are some useful comparisons we can make, in particular with AJ Bell's advisor business, because they do report the two halves of the business separately. So in terms of size, IntegraFin's average client account value seems to be about 240,000. So that's a bit smaller than AJ Bell, which has an average advised client account size of about 310,000. So AJ Bell's clients are maybe slightly wealthier, but there's probably not a huge amount in it in reality, I suspect. Again, AJ Bell also manages to generate a bit more revenue from each of its advisor clients. So I think IntegraFin's clients generated an average of about £580 of revenue each last year, and the figure for AJ Bell was about 650. Similar ballpark really for both of them, but AJ Bell seems to be attracting slightly more affluent clients and making slightly more money from each of their accounts. But I think one thing that's interesting that may reflect on this is that the two companies have a slightly different approach to fees. Although they both charge similar levels of fees as a percentage of assets, I think broadly speaking, which one is cheaper will depend on how much you have invested. But perhaps the more significant difference at the moment is the way that each company treats interest. With a lot of investors holding quite a lot of cash at the moment, this could be a bit of a sting in the tail for AJ Bell customers, because what happens is that IntegraFin passes on all of the interest it earns on client cash directly to its clients. So in April, the company said it achieved an interest rate of 3.8%. AJ Bell, on the other hand, only pays out a portion of this interest and keeps the rest. So from what I can see, advised clients at AJ Bell got between 1.65% and 2.3% on their cash in May. So that's really not quite as good as 3.8%, especially at a time when a lot of investors are holding more cash than usual.
Yeah, so it's very commendable that IntegraFin pass on all the interest to the clients, which, as you've said, not every stockbroker platform does. There's what company calls responsible pricing. That's its mantra, responsible pricing to its clients. So it's trying to position itself as perhaps a disruptor in terms of fees. So it's made a deliberate decision to pass on the economies of scale and benefits to the customers. So if you look at the 2018 flotation document, the company said that it had made refinements to its charging structure, whereby it has shared some of the efficiency gains from scale with clients. The directors intend to continue this approach as they believe it assists with retention by rewarding loyalty and attracts new business from clients elsewhere. So there's been a declining fee rate at IntegraFin. In 2015, they were charging 37 basis points, and now they're charging 26 basis points, which in plain English means for every £1,000 you hold on the platform, you pay £2.60 a year in fees. And these are just the Transact platform fees. You've got to pay your fees to your financial advisor on top. So the management fees do not seem outrageous. They don't seem bargain cheap either. So if you've got £60,000 on the Transact platform, you pay 0.5% a year, which is £300, which I think seems a little steep. But if you've got £100,000, you pay 0.26 a year, which is £260. So you've got this odd situation here where the more money you've got, the less you pay a little bit. If you're lucky enough to have £1 million, you pay 0.22% a year, which is 2,200. And if you've got £5 million, you pay 0.1% a year, which sounds really cheap, but it's still £5,000. But I guess clients or financial advisors are used to paying the fees. What surprised me was the cost of an ISA. It's just £12 a year, which I think is pretty good. SIPs are £80. And the dealing charges, these seem to be minimal. Looking at the website, it seems like a lot of clients just don't pay anything or very nominal fees for buying and selling investments. So I just get the impression there's a heritage perhaps of disruption here of being a client champion. It was the first platform of its type in the UK. So the company was founded in 1999. I think the platform was launched in 2000. I listened to a podcast last year with Mark Dampier. So Mark Dampier was the marketing director of Hargreaves Lansdown. And he recorded a conversation during this podcast with Peter Hargreaves. And he said something on the lines of, look, Peter, we better be looking at Transact. This conversation was at least 20 years ago. So I just got the impression from that podcast that perhaps Transact inspired Hargreaves Lansdown. So I get the impression this business is a pioneer and continues to be a champion for clients. Or at least I like to think so.
That's interesting you mentioned Transact coming before Hargreaves Lansdown's platform, because I think that a lot of people, possibly me included previously, would have assumed that Hargreaves Lansdown was the first of its kind or to build one of these modern platforms. So that is interesting. We've mentioned the growth in client assets, but what we haven't really talked about is where this growth is coming from. So is IntegraFin's growth being driven by the company signing up lots more advisors, or are its existing advisors providing more clients or more client funds?
It's a combination of more clients, more advisors, and more advisors bringing in more clients. So there's 225 clients on the platform at the moment, and that number's almost doubled in 8 years. So they've been growing at about 8% a year. Advisors, there's 7,600 at the last count. About 700 of those don't have much in the way of clients, so the company tends to ignore them. So if you strip those advisors out without any clients, that number has been growing at about 4 to 5% a year in terms of advisors. So from those stats, you can work out the number of clients per advisor, which is 33. That's been growing over time. It was 25 a few years ago. And the money per client, as you've said, is about £240,000. That's up 71% since 2015. And the money per advisor, the client money per advisor, each advisor now looks after £7.6 million on average of client money. That's doubled since 2015. So what all those stats mean is there's more advisors on the platform, but they're bringing in more clients. And I think they're bringing in richer clients as well.
All sounds like quite healthy growth to me, but it's looking up and looking at the numbers more generally, and I think the market as a whole has got bigger over this period. So while IntegraFin's total client assets, I think, have risen by about 10% a year since 2018, but when I look at AJ Bell's advisor platform, they seem to have had a similar rate of growth, about 10% a year in total client assets over the last 5 or 6 years. So IntegraFin hasn't necessarily outperformed in terms of market share on that measure, although I think it does have a decent share of the market. Of course, one other reason why all these platforms may have seen their client assets growing over this time could be just that the client investments have been performing well and benefiting from rising markets.
There is some evidence of that, but not a lot. Each platform, so Hargreaves Lansdown, AJ Bell, and IntegraFin, they all publish quarterly numbers about the amount of money on the platform, client money coming in, client money being withdrawn, and the market effects on portfolio values of the client money. So looking at those stats for IntegraFin, I think from 2015, the client money coming into the platform has been £48 billion. Client money withdrawn, 18 billion. So there's been a 30 billion net inflow. And the total market movements has been 8 billion in comparison. So doing some quite complicated mathematics, I've worked out that the typical investor client on IntegraFin has earned 4% a year in terms of market movements over the last few years. So not fantastic. Whether the clients are happy with 4% a year, they may not all be invested in high growth funds, but let's put it that way. So they may be quite happy with 4%. But it does tell you that growth has been driven by extra advisors, extra clients, all putting money on the platform, which is good. One thing I have noticed is that clients seem to be withdrawing less money from the platform. So before the pandemic, typical client would withdraw about 7 to 8% of their portfolio every year. That's down to 6%, which I'd like to think is a bit encouraging.
So the advisors seem to be doing well, and the clients maybe are happy too, because as you say, some of them might be more concerned about looking after their capital and being able to withdraw a regular income without paying too much tax. Talking of tax actually brings me to the next question, because as you mentioned earlier, quite a big chunk of IntegraFin's assets seem to be invested in certain types of insurance products, including these onshore and offshore bonds.
I'm not an expert in these products, that's for certain, but these are tax efficient investment vehicles for wealthy investors. So let's say you've maximized your pension contributions, you've maximized your ISA contributions, you're on the limit for capital gains tax. Where else do you go for tax efficient investing? Well, you could consider onshore and offshore bonds. These are not actual bonds, but the vehicles where you can invest in different asset classes such as shares, funds, bonds as well if you want. And you can enjoy some convoluted tax advantages. And I guess the word offshore, that conjures up some sort of dodgy tax, but these are genuine products. So you've got mainstream providers such as M&G, HSBC, Standard Life offering these products for sale, and they're all legit. So if you take out an offshore bond, let's say, that's handled in somewhere like the Isle of Man or the Channel Islands, where there's no tax. So your gains compound in these vehicles without any tax interference. There's a life insurance element as well. So you can structure these products in a trust, and they can be used for inheritance tax planning purposes. The tax, when you do pay tax, as I understand it, is treated as income, which is useful perhaps if you're a higher rate taxpayer and you think you're going to be a lower rate taxpayer in the future. You can use these products to benefit from that change in your taxation circumstances, or if you're planning to live outside the UK as well. These products could be useful for tax planning purposes there. But one thing I do know for certain is they require financial advice. I looked at Standard Life's documents about these products, and they say this product you are buying is not simple and may be difficult to understand, which I think is putting it mildly.
Yeah, that sounds like a fair comment. I think one quote I saw when I was looking into these is that they are basically investment products disguised as single premium life insurance contracts. I'm not sure I even understand the sentence, but they do seem to have benefits that are designed to allow people to withdraw income in a tax efficient way. So I guess they're targeting more affluent people. So apparently it allows you to withdraw 5% of your original investment each year for up to 20 years while deferring any tax that might be due for that whole period. And there's also something even more complicated called top slicing relief. So really, as you say, neither of us are tax advisors, and these products definitely require expert advice. But one thing that seems more simple to understand, and I think we're both more confident about, is that these bonds seem quite profitable, more so maybe than standard investment accounts like ISAs.
Yes. So looking at the segment profit notes in the accounts, your standard investment products such as ISAs, SIPs, dealing accounts, they typically represent about 40% of profit each year. And the non-standard investment profits typically represent about 60% of profit. So these non-standard investment products include these onshore, offshore bonds, but also old style personal pensions and executive pensions as well. So there's a whole range of these slightly more elaborate financial advisor products. They contribute about 60% of profit, but represent about 40% of client money. So yeah, they do make more money. I think IntegraFin, they charge the same sort of management fee. I just think the admin costs are just a lot lower for some reason, which I don't know. The administration costs of these more sophisticated products are just lower for IntegraFin. So I have noticed in the accounts, IntegraFin do reveal how much the financial advisors collect from these more sophisticated products in fees. Last year, it was almost £200 million from client money of about 22 billion invested in these particular products. So if you work it out, it's almost £30,000 per advisor in fees. So I can understand why financial advisors want to sell these products, let's say.
And I guess that providing these services to the financial advisors, it also seems quite profitable. Given all these big margins and nice fees that are swirling around, I guess IntegraFin probably does face plenty of competition.
It does. So commendably, the company in its results presentations lists out the top 10 players in this market and how much client money they have. That it does that on a regular basis. So the competitors are from the last results presentation are Aberdeen with £70 billion of client money, Quilter with 69, then there's Transact, IntegraFin with 54. Then you've got Aegon, AJ Bell, Fidelity, Aviva, Advance, which is owned by Lloyds Banking, James Hay, and True Potential. So those 10 names control about 80% of the UK advisor market. And IntegraFin has a 10% market share, but it's been growing its market share. So it was 9% a few years ago. Now it's almost 10, which doesn't sound a lot, but it's increasing. And in the last half year results in the presentation, they said they captured 19% of new money coming into any UK advisor platform. They captured 19% of that. So that's pretty impressive. On that list of 10 competitors, I'd never heard of True Potential before. So I looked them up, and they're a large wealth management investment business. And on these IntegraFin's results presentations, they list out who supplies the software for all these 10 different competitors in the market. And the two that own their own software are True Potential and IntegraFin. And funnily enough, the two which are the fastest growing at the moment are True Potential and IntegraFin. So I just wonder, having your own in-house software gives you greater flexibility and control, and that's now showing through in terms of IntegraFin's performance by capturing more client money than the rest of the market. I think that gives a competitive advantage.
IntegraFin's market share might be more impressive than it sounds in some ways. Just to expand a bit on one point, because Transact serves independent financial advisors. The platform and the services it provides are the products, whereas some of the larger competitors you mentioned, Aberdeen and Quilter, for example, they're really fund management businesses or asset managers. They're in the business of selling their own products. And I imagine the advisors using those platforms are largely tied to selling, say, Aberdeen products. So in the independent section of the market, Transact actually has a much bigger market share than those numbers suggest. So it is quite a dominant business in its niche already, I think. And I suppose as a potential investor and probably as a customer too, I quite like the idea of an independent platform. When companies are only trying to sell their own products, you always feel there's a risk that customers may be paying full price but not getting the most competitive choice of products. But it has recently paired up with a big fund manager itself to offer a new service, hasn't it?
Yeah, so Blackrock, it's announced a model portfolio service with Blackrock last September. So Blackrock joins the platform as a discretionary fund manager. Now, these are becoming increasingly popular with advisors on the platform. So the advisor doesn't make the buy and sell decisions. It gives the client money to somebody else, a discretionary fund manager, to buy and sell. So with this deal with Blackrock, advisors get an exclusive service with low fees in its funds, which are ETFs. There's not many ETFs on the Transact platform. I think because generally they don't pay much in fees for the advisor. So this is the first UK model portfolio service for Blackrock. It wasn't mentioned in the last results. So after this announcement was made last September, it was talked about in the results straight after that, but not mentioned at all in the last results, which makes me feel it's got off to a bit of a slow start. So IntegraFin did say they're not doing this to make any money, which I thought was a bit surprising. It's just to broaden the scope of what's on offer for advisors, just to retain them, to stop them leaving. And you do have to think about discretionary fund managers and the sort of layers of fees building up here, because if you are the end client, you're paying fees for the platform, Transact, you're paying fees to the advisor, you're paying fees perhaps to the discretionary fund manager, and also fees to the underlying fund as well. So the fees are all mounting up. I think the interesting part of this Blackrock news model portfolio service is BlackRock is a 7% shareholder. I just wonder if this is BlackRock getting involved in IntegraFin in a little bit more of an intriguing way, actually. I wonder if they can get involved in IntegraFin in a bit more depth in the coming years, I think.
Well, I think it's a well-developed platform, so it wouldn't be completely surprising, maybe, if one of these larger fund managers wanted to take a look at it at some point. But as far as model portfolios go, from what I've heard and read really recently, they are quite a fast-growing area, so perhaps this is something that financial advisors will pick up a bit more when they become more familiar with it. I'd like to hope that BlackRock would be able to put together better model portfolios than most financial advisors themselves. Whether that offsets the extra fees, it's not really clear. But at least these ETFs, they are quite a simple, low-cost product, generally speaking. And model portfolios too, I think, are fairly easy to understand. But looking at IntegraFin's accounts, they aren't always so easy to understand and to decipher for private investors, are they?
No. So those onshore, offshore bonds and those other sophisticated financial advisor products, the client money involved in those vehicles, they're included in the accounts. So £22 billion of client money is in the accounts on the balance sheet. The movements in client money in those particular products interfere with all sorts of ratios. So if you look at SharePad or Stockopedia, your ratios there may be distorted by lots of client money interfering with the accounts. But I picked through the accounts. One thing I can say for certain, this is a cash generative business. So cash on the balance sheet is £180 million. And that's improved by almost £100 million over the last 7 years. During that time as well, the company's paid out £170 million as dividends as well. So it's not all surplus to requirements, that cash. There's some of it needs to be held for regulatory reasons. And there's also something the company calls a risk appetite capital, which I think means money they want to hold over for a rainy day just in case bad things happen. So I think there's £43 million available for shareholders. There's no debt of any type on the balance sheet. And all this cash is earning interest now. So in the last half year results, they earned a useful £2 million, which was 8% of total profit, which is not bad. Margins were high in the last accounts, 39%. They were 49% in the previous year if you strip out the adjustments. And what's impressive is this business seems to grow on thin air. So last year, the company made a profit of £54 million. But if you look on the balance sheet, there's plant, property and equipment of just 1 million. There's no stock, and the working capital position is a negative 2 million. So there's minimal operating assets here. And the ratios, ROE or the return on invested capital, are just fantastic.
Yeah, I agree with you that the underlying cash generation and the profitability of this business really looks exceptional. It's a very nice enterprise. But when I started looking into it, I originally assumed this was just basically a software business, but it is a bit more complicated than that. When I started looking into the business, into the structure of it, I found IntegraFin also owns two insurers. So there's a UK one and its own offshore insurance business. And it's these units that write all of these complex pensions and insurance bonds that we were discussing a few minutes ago. So these insurers, I think, are a sizable part of the group. I think the UK insurer had 99,000 policies at the end of last year and generated half the entire group's operating profit. So I'm not sure exactly how unusual this is or whether it generates any extra risk compared with, for example, AJ Bell. But my impression is there's not really too much to worry about, that these bonds, the risk of losses is largely with the clients and that there's no unpredictable big payouts like a conventional insurer might face. Is that your understanding too?
Yes, that's what I like to think is happening. It looks quite scary. You open up the accounts and you find a 22 billion unit linked insurance liability, and you think, well, what's that? That's all covered by or offset by the client money, which has the same value. So all these sophisticated financial advisor products, yeah, there's an insurance element to them. And so the accounting means they have to go onto the balance sheet. And it does look, some of the numbers do look scary. But as far as I'm aware, is that any obligations from these insurance policies as such is all counterbalanced by the money in the underlying client portfolios. So there's no great big insurance risk on the horizon or some sort of sudden massive insurance claim suddenly appearing, I think. I'm pretty sure. So there's insurance type accounting here, but there's not insurance type risk to shareholders. It looks odd, but everything is counterbalanced by the money. The obligations are all counterbalanced by the money in the client portfolio. So the net effect to shareholders should be zero.
It all sounds fairly safe as long as it's well managed. What is your view of management? Are you a fan?
I am. I like Mike Howard. We talked about him, mentioned him earlier. He's a co-founder. He's still an executive. He owns 10% of the company, which is worth £80 million at the moment. So he has sold half his shareholding at the IPO or since. I do like that he is a thin cat. So in the last annual report, they said his only pay was 80,000 Australian dollars, which converts to 43,000 pounds. So yeah, he seems to be good value. He does collect a £3 million dividend, so he's not truly hard up. He's in his mid-60s though. So at some point he will retire. But the fact that he's a co-founder, he's on the board, he owns a lot of stock, he doesn't take much in the way of pay is very positive for me. I think he's on the side of outside shareholders. So chief executive, he's been at IntegraFin since 2009, chief executive for 3 years. The other executive, he's been at IntegraFin since 2011. He's been on the board for 3 years as well. I don't think there's anything obviously untoward about those executives. The pay is not outrageous and there's no LTIP. I read this fantastic line in the annual report. We firmly believe that a traditional LTIP with 3-year time horizons would, for our business model, drive the wrong behaviors. We do not believe that high performance pay upside, measured over just 3 years, is a pay model which aligns to proper long-term thinking, sustainability, and stewardship of our business. Amen to that.
Amen. Yeah, indeed. So there's only seems to be one obvious problem with the board that I've noticed.
There's no CFO. When I wrote my SharePad article last year, I noticed some disclosures in the annual report. The profit disclosures just didn't add up. There was arithmetical errors in the notes to the accounts. And I've also noticed last year the company had to pay £8 million of backdated VAT because it's been in a dispute with HMRC and lost on a VAT case. And the year before that, I think there's a £5 million tax reserves error relating to policyholders. A few years before that was a technical dividend infringement, which required all sorts of AGM paperwork. So you've had a string of niggling errors here, reporting errors, calculation errors, which I think a proper CFO would have averted. So they're on the lookout for a CFO, trying to find one, not found one yet. And I just think it's a bit slapdash, really, for what is a £800 million FTSE 250 business not to have a board CFO. So there's some awkward text in the audit report. highlighting some of the shortcomings of the lack of CFO. So the new auditor was appointed last year, Ernst & Young, and it said in the audit report, "We have considered the design effectiveness of controls over financial reporting, including IT general controls, to determine our audit strategy. We concluded we could not rely on the operating effectiveness of IT general controls. We have reflected this in our audit strategy." I think there's been a frank discussion between the auditors and the board, and the auditors have said, improve your reporting. Yeah, the company needs a CFO. There's 5 non-execs on this board with backgrounds in the city, accounting, and legal. So the great and good of the city are sitting on this board, and none of them spotted the errors in the annual report that I did last year. Are they earning their £70,000 fees? Not sure they are.
This kind of thing, it isn't ideal, especially in the FTSE 250, and it seems an odd oversight not to have had a CFO, but I suppose looking at it objectively, none of it sounds too sinister. I think whether it's more the case that IntegraFin has never built up the proper financial infrastructure for a large listed business, it could be a legacy really of the founder management and its startup culture, almost a bit like Superdry, which we discussed in the Investors Roundtable podcast recently. Just hasn't got the infrastructure it needs to keep its finances under control.
Yeah, not as bad as Superdry. That was awful. If you compare the audit reports, Superdry was pretty bad.
Yeah,
This one not that bad.
No, perhaps a little bit of an unfair comparison, but certainly IntegraFin seems a much better business to me. Talking of which, the half-year results were out recently. We've seen a lot of companies reporting higher costs over the last year for obvious reasons. Is this a trend that you're seeing at IntegraFin as well?
Yeah, so staff costs are rising. So on that point about maybe run the business on a bit of a shoestring and lacked investment in the company and its controls, staff costs were up 12% in the last half year. So total costs were up 5%. Revenue was static. So profit was down £5 million. Still a good group margin, 39%. But I do get the impression that it may have been understaffed previously. Some of these costs creeping into the business now or marching into the business. They may reflect not just investing for growth, but just catching up on what you should have been investing in or paying staff a few years ago to build the company. The company may have been just caught out a little bit by tough market conditions recently. I don't know. Have you looked at the Transact website?
It's not the most modern website that I've seen recently.
It's at transact-online.co.uk, and even that website address suggests it comes from the very early 2000s. So the website, I think, best could be described as functional. It's not very modern looking. And that does suggest that maybe this platform has not had the most tip-top IT expenditure on it, but it seems to be working. This is the thing. The clients moving the money there, the advisors are moving the money there as well. So it seems to be working. But the impression is, I think it's been understaffed, this business, and that understaffing or lack of investment is now catching up with the company.
Yeah, I think I agree with you about the website, although it's something I've noticed really with quite a lot of financial businesses as a customer kind of in recent years, that once you go through the login process, what's behind there is often a lot more dated and clunky to use. And I think upgrading that's sometimes harder than it might seem. But more generally, I don't think the staff costs look too worrying to me, given inflation as well as the need to invest for growth and retention of good people. I don't mind seeing the company spend a bit more if it has the potential to continue expanding. But I'm not completely sure, looking at some of the numbers, about IntegraFin's growth potential, because the numbers provided by the company seem to show that it already has a share of about 60% of the independent advisors in the UK market. So that excludes the majority who are tied, and we're just talking about ones who can sell almost any product. So if there are only 13,000 independent financial advisors and about 7.5 are already signed up with IntegraFin, I wonder if the business could eventually struggle to continue growing and signing up new advisors.
Yes, I've thought about that as well. There's a slide on their results presentation with all these details. So they've got 7,500 advisors. They can capture at the most apparently 5,500 or so. Do you think all the low-hanging fruit is gone? This question was asked on a recent webinar about, are you going to run out of advisors? And they said most advisors use more than one platform. So they have some advisors on the platform who've got 80% of the client money on the platform. And they've got others with 20% or less. If you've just joined the platform, they said if you join the platform as an advisor, the advisor typically puts their own portfolio on it first and then gradually moves clients on. And apparently it can take 3 to 5 years to test drive the platform before you get comfortable with it and your clients get comfortable with it, to bring more and more of your clients, the advisor's clients, onto the platform. So it's a slow process of getting towards 80% of your client money. So yes, there's not as many advisors to capture for the platform, but there's loads of clients being handled by existing advisors on the platform who are yet to move across onto the IntegraFin platform. In the results presentations on the slide, they show where all the new money is coming from. And the bulk of it's coming from established advisors on the platform, bringing in new clients, and also current clients bringing in money themselves. I think there's a lot more growth to come, even if the number of advisors is shrinking to be able to join the platform. The established advisors already on the platform, they've got loads of clients still to migrate onto IntegraFin. So I'm not too worried about a lack of advisor growth. I'm quite relaxed about that.
Looking beyond the core platform business, does IntegraFin have any other growth projects in the pipeline?
Yes, there's a small business called Time for Advice. This was acquired the other year. It's got sales of less than £5 million. It doesn't make any money. It supplies back office software for IFAs. The plan now at the moment is they're building an integration with this back office software with Transact. The small print in the annual report suggests that progress at this Time for Advice business has been behind expectations. It's not on my spreadsheet, put it that way. You look at the results presentations and you can work out that the company generates from this small business £1,000 per back office user. So perhaps if it all integrates with Transact and in the next year or two, you can imagine the company trying to sell this software to the 7,000 plus advisors on its site. And I don't know how many back office staff each advisor employs. It's interesting. It could be a little bit of a money spinner. I don't think it's really going to make a massive impact on shareholder returns in the near term. Let's put it that way. It's not on my spreadsheet, as I've said.
It doesn't sound like it will have any impact on the group's earnings for the foreseeable future. But speaking of earnings and valuations, you mentioned earlier that IntegraFin's price to earnings ratio had fallen from a high of about 40 to, I think, 17 today. What's your view really on the valuation here? Given the profitability of the business, do you think it justifies a premium valuation, or do the shares still look fully priced to you?
I don't think they're fully priced. One thing's for certain, it's better to buy them now than it was the other year, priced at 40 times earnings and £6. And they're now at £2.40. I think these are very interesting now. I think the high margins, cash-rich nature of the business, the terrific sort of investment credentials of this business where you don't need that much in the way of capital to grow earnings. I think that deserves a pretty premium rating, to be honest. And yeah, so 17 times earnings, that's not pricing in much growth, I expect. So yeah, the dividend is over 4% now. One thing I did notice with the dividend policy was the policy was 60% of earnings. Now it's 65% of earnings. And if you look at the forecasts of a 10 pence, just over 10 pence dividend, and earnings of about 14 pence forecast is 71%. So it looks like they're going to breach the dividend policy. But I think the dividend will be maintained. And the general valuation of this company does look relatively modest. The other year, you'd have been saying if you can buy this business on 17 times earnings, it would be a bargain. So yeah, I'm interested, seriously interested in looking at this company. It's definitely on my radar.
Yeah, I can see plenty to like about IntegraFin shares at this price too. I think it looks very reasonable. I suppose the only thing that I'm not yet decided on is whether it's truly a better choice than AJ Bell in particular. In terms of valuation, AJ Bell is also on a pretty similar valuation at the moment. But from what I can tell, the earnings forecasts this year are a bit stronger and possibly it's a little bit more profitable, although as we've discussed, it's sometimes difficult to tease that out of IntegraFin's accounts. But I like the transparency, though, of the Transact platform and the interest payments and the greater level of involvement from the company's founder, too. So from a total return kind of viewpoint, I might still be tempted to choose AJ Bell, but I think I'd need to look at them both side by side, really, to form a conclusion. I think they both look potentially attractive at the moment.
Yeah, I'd need to look at AJ Bell as well in depth, but I don't think there's any harm in owning both if you like both of them. I think in terms of the three with Hargreaves Lansdown, I find it difficult to like Hargreaves because of its high fees. I just get the impression, having looked at Hargreaves over the years, it has a dependence on inertia for clients, especially on its fund management fees. And I don't like the management change there as well. So I think about 18 months ago, the then chief executive introduced this big new costly plan, and then he left earlier on this year. So there's a strategy vacuum, I think, at Hargreaves. So I'm not a big fan of that. But AJ Bell, IntegraFin, at the moment, I like IntegraFin because it's got a founder still on the board. He owns a lot of stock. Andy Bell has left AJ Bell now, so he's on a 1 day a week consultancy, which is perhaps not ideal, but you're still involved somehow. But you've still got the co-founder Mike Howard at IntegraFin, and it's a client champion. Or at least it is portraying itself as a client champion. It's giving all the interest it earns for client money back to the clients, as a responsible pricing strategy of cutting fees every so often, which I don't think happens at AJ Bell and Hargreaves unless they're pressured into it by market forces.
No.
It's on my, of the three at the moment, IntegraFin is, I think, my favourite. But although I've not looked at AJ Bell in any great depth, but I don't think I'd buy Hargreaves. But IntegraFin, I'm seriously interested.
I'm a bit more positive than you on Hargreaves Lansdown. I think maybe because of my interest in income. I think you're probably right to say it relies on inertia, and its fees are maybe towards the upper end of what's really competitive, but it does have something like a 40% market share, and obviously lots of customers. Inertia is a powerful force, I think, with these things, and I think really Hargreaves holds all the cards, and it should only really lose if it becomes too complacent or is mismanaged. So as you say, it'll be interesting to see what the new chief executive says and does when he or she arrives, and whether Peter Hargreaves is a bit more positive than he has been in recent press commentary on the business he founded. But more generally, all of these shares have sold off a lot over the last year, and we're talking about the valuation. What are the remaining risks, do you think? Are we missing something? Could things get a lot cheaper, a lot worse?
If there's a market crash, then yes, I think these shares would be hit. If there's a market crash, the value of the client money declines, the fees decline in tandem, and profits decline as well. In IntegraFin's stress testing scenarios in the annual report, they talk of a 33% market decline over 1 month as one scenario. 30% exodus of clients over 3 months, £20 million of extra costs marching into the business. So they've said they could cope financially, assuming the market rebounds over time. The other risk is with all these elaborate financial advisor tax wrapper type products, the offshore, onshore bonds. I don't have much visibility in terms of any sort of regulation change there, and whether this government, the next government, looks at these sort of products and think we could do with a bit more tax, let's change the rules and make these products redundant, or at least not very attractive for advisors to sell and collect fees. So that would influence this business. I think the onshore, offshore bonds don't have a great proportion of client money invested in them. It's more among these sort of more elaborate products, the personal pensions and the executive pensions. So I'm a bit more relaxed than I was, because when I first looked at this business for SharePad, I thought there's a lot of money in these offshore bonds. This looks quite suspect. But the blind spot I have is with these elaborate products. If there's some sort of rule change with the government, that could make advisors stop selling these products, and that could interfere with IntegraFin's progress. But generally, I'm quite relaxed about it. If that happens, okay, but I would take that risk, I think.
Yeah, I think that's probably fair. Even if the rules changed, IntegraFin would still have a very sizable share of its target market, and financial advisors would no doubt adapt to selling whatever products became available instead. I don't think it would be an existential problem for the company. It might just result in a minor change, maybe in fee levels for a while.
Does this share meet criteria for your portfolio, your website portfolio? Would it appear in your model portfolio?
I think it definitely could. IntegraFin, I have noticed the shares have shown up in my screening results in recent weeks and months. And as we've said, the valuation doesn't seem too bad, especially now the dividend yield is up to 4%. So yeah, I think it is definitely a business I could imagine holding, hopefully for a long time. I'm definitely a lot more interested than I was before I started to look into this business.
The shares got to £2 last year. That was the low point last year. If they get to £2 now, it's over a 5% yield, and I think 15 times earnings. That would be very difficult not to buy, or at least not to be seriously interested in that. So £2 is the marker I have. £2.10, I think, is the sort of marker I have in my mind, is where that might be too irresistible to stand by on the sidelines, I think.
Yeah, I think I've noted down £2.20, but certainly anything down in that region, I think all things being equal, you'd have to say it was probably cheap.
Well, that's it for this time. Thanks for listening to the Private Investors Podcast. If you enjoyed this episode, please do consider supporting our podcasts through a monthly subscription. That way you'll keep the podcast going and help us remain free of awful adverts. That website link again, pipod.co.uk. And if you join us before the 1st of August, you pay £10 a month instead of the normal £12.50. Until next time, thank you and goodbye.